had some heavy overnight selling, but is this really an inflation story? Bonds sold off sharply last night, with 10-year Treasury yields going back up towards the 4.10% mark. Mortgage-backed securities are down roughly 3/8 of a point. That's putting some upward pressure on mortgage rates. At the same time, we're seeing higher oil prices and higher bond yields moving together. On the surface, that seems to support the familiar narrative: higher oil equals higher inflation equals higher rates. But it's not really that simple. Let's take a closer look. If inflation fears were truly accelerating, we would expect to see a clear rise in market-based inflation expectations, the kind measured by inflation-linked securities. Yet one of the most widely watched inflation expectation gauges has shown almost no increase over the past 2 days. That's a significant disconnect, and several sharp analysts are pointing it out. Yeah, short-term tips or inflation-protected treasuries show a slight uptick in inflation concern, but not nearly enough to fully explain the magnitude of this bond sell-off. So if it's not purely inflation, what else could be driving this? One increasingly plausible factor is Treasury issuance expectations, especially tied to potential increases in military spending. More government spending typically means more debt issuance, and more supply of treasuries can push yields higher, independent of inflation concerns. Why this matters for mortgage rates. Mortgage rates follow bond yields and MBS pricing. With MBS down and yields rising, borrowers may see modest upward pressure on rates, but the important nuance is this. This doesn't appear to be a broad inflation panic. It may be more about supply dynamics and positioning. And if inflation expectations remain stable, the sell-off may not snowball. Bottom line, rates are moving a little bit higher, but the inflation is back narrative doesn't fully hold up under scrutiny. The bond market may be reacting more to a potential debt issuance and supply pressures than a true shift in inflation expectations. For mortgage rates, that means near-term pressure, but not necessarily a fundamental change in the longer-term outlook. I hope this information helps. If it does, give me a like and a follow, and I hope you have a great day.